account receivable decrease credit, the contra account decrease mean debit. So entry would be reverse. Allowance for uncollectible accounts to account receivable RS or RS. Right? So what is the benefit of doing that one? Our income statement is not hurt. Our income statement is not hurt. Why? Because we already expensed $88 million to the income statement as uncollectible expense. Right? So we directly charge our allowance to the account receivable. So if you put that entry in our ledger accounts, so you see 9 is charged to the reserve and 9 is charged to the account receivable. Now what happened here? This is cancelled because 0 is balance here, and our allowance is decreased to $89 million. Right? You see here, now our total account receivable is going to be now 11,019 minus this allowance is 89. Answer would be again the same, 10,930. So you see here the net account receivable is not disturbed. If you don't, if you forgot the previous example here, so let's just go back to here, whether we have the same total net. See? If we add our account receivable total, it would be 11,028 minus the allowance 98. Answer would be 10,930, right? So this will go to the balance sheet. So this figure remains the same. That is the beauty of allowance using allowance method. Now what happened? This RS didn't pay us. So what happened here? If RS didn't pay us, then we charge RS, we delete the RS value here and we charge this RS default write-off to allowance. And what happened here? Our total amount of account receivable is now 11,019 minus the rest of the allowance here. So you see here, it remains the same, 10,930. Now our planning and our balance sheet is not disturbed, right? Similarly, our cash budget is not disturbed, our income statement is not disturbed because we already expensed $88 million over there as an expense for allowance collectible, uncollectible, right? So this is the beauty here. So impact of write-off is that before write-off, our account receivable was 11,828. And after the allowance, total value was 98. Our net value of account receivable is $10,930 million. When actual expense happened, our account receivable decreased to 11,019. Our allowance decreased to $89 million, and our net value is not disturbed. Right? So this is the beauty of using allowance, so that our balance sheet does not experience variability during the accounting period. It remains the same, stable, normalized. We use different words for, stability, normalized. Right, everyone? Marilyn, understand? Harry, understand?
Yes, sir.
Nam,
Yeah.
understand? Pin, you understand?
Yes.
Good.
Yes.
Good. So the difference between these allowance method is that in percentage of sale method, the answer is we need to adjust the allowance for uncollectible account by the amount of uncollectible account expense. The percentage of sales methods give you the expense. Then you add the balance here. It will give you the total allowance value. But the aging of receivable adjusts the account allowance for uncollectible accounts, the total amount of uncollectible allowance for receivable, right? In that, you need to find out expense. You just less the opening balance, that's it. So that is a small difference. And yes, these two methods are totally different methods. So their value result, their value does not necessarily came up with the same numbers. Okay, it can be different values. So if you understand all this stuff, do this illustration. I'm gonna be please take a picture. I'm gonna be setting up the breakout rooms. Here we go. So I'm setting up 2 breakout rooms, 2 each. Good. So now take a picture and try to solve it. What you need to do, you need to make the entries, right? And at the end, you need to show the partial balance sheet of what happened to the accounts here. So let me setting up, and those who are watching online, so just pause the video here and try to solve it by yourself. And then at the end, we match our answer. So I'm going to be pausing the video here. I'm going to be resuming after the breakout room activity. Okay, class, welcome back after the breakout room activity. So some of you already sent me the breakout room activity, and quite impressive. Okay, let's see the solution here. Okay, let me read that. So on November 30, High Peaks party planners had a 34,000 balance in account receivable. So if question is silent, which balance it is? Debit or credit? Guys, this is debit balance or credit balance? Participate.
Debit.
Well done, because the normal balance for assets are debit, and 3,000 credit balance in account in allowance for uncollectible accounts. So we have a credit balance 3,000 already in the allowance for uncollectible or reserve for bad debts. So during December, High Peaks party planners made credit sales of 159,000. December collection on accounts were 130,000, and a write-off of uncollectible receivables total 2,700. Remember, what is the entry for write-off? You charge write-off to allowance and account receivable, right? And account receivable, right? And remember, uncollectible expense is estimated to 1% of credit sales. How much is the credit sales? 159,000. So we have all the data here. So let's see the first requirement. Generalized sales, collections, write-offs of uncollectibles and uncollectible expense by the allowance method during December. So which allowance method we are using? Because we are given the percentage of sales, credit sales, so we are using percentage of sale method, right? Explanations are not required in the journal entry, so we'll just see that here. So first requirement, 3 entries. Number 1, sale happened, and this sale is credit sale. What is the entry? Account receivable to sales, 159,000. Well done. Cash received from customer, 130,000. Cash received, cash debit. Against what? From collection, it means it's from account receivable. So cash to account receivable, 130,000, pretty simple. Write-offs. What did we call the write-off? Write-off entry would be, we charge this to account receivable and allowances. So entry would be allowance for uncollectible to account receivable, right? Now the second requirement is show how high peaks party planners will report account receivable and net sales on its balance sheet and income statement. Oh, we allowance method, we just skip that one. So our fourth would be the high peaks party planners make a credit sale for 159. So 159,000 multiplied by 1%, answer is 1590, right? So what is the entry? Entry is the same because this 1950 is the expense and allowance amount. So that will directly go to income statement and balance sheet. And it would be uncollectible expense to allowance for uncollectible, right? So we just put all these journal entries into our ledger, into T accounts, 34,000 balance and 3,000 balance already given. So just put here account receivable decreased by 130,000, that is cash collection, new credit sales, write-offs, new allowance here. The total balance 1890, and this is the balance for total account receivable. So how we are going to show on the balance sheet? On a balance sheet, this amount is going to be shown. How? 60300 minus 1890. Balance going to be 58,410. How we are going to show that? Here under current assets, receivable 60,300 less allowance. So net value will be 58,410. And on income statement, it doesn't affect our sales. So that is the 1% of sale and all the stuff belongs to uncollectible and expenses. It has nothing to do with our sales. So sales remains the same. Marilyn, did I answer your question?
I'm still confused. Can you please repeat?
Okay. All the procedure is related to account receivable and its collectibility.
Yes.
Okay. It has nothing to do with sales. Right? So sale remains the same.
Okay.
Right? So that is if collected or not, that if not collected, that becomes our expense, and then we will less from expense, but sales is not affected. It has nothing to do with sales. Okay?
Okay.
Good.
Okay.
Good. Okay, now direct write-off. Now, what if we do not plan for this reserve method? We don't want to be a smart manager. Why? Because our business is not so much big. Normally this write-off stuff, and we saw that this $98 million, $88 million, because their sales are, Apple company sales are 136,000, $100,000 million. So, but if the company is small and they say that we don't want to do this allowance method stuff because we are a small company, so can we do that? Yes. In that